totally got it. Now I understand it. And Connor, like now, let's start like our investment conversation. Like because this episode, I really want to target the beginners, especially like students in Canada and even international students. Like I'm coming from same background as an international student, and I recently started investing. Like last year, it's been just over a year. Like I started investing in index funds and individual stocks.
Mhm.
So, what would you say are some of the must-do things in the early age of investment? Like for me, beginner, for international students, what are some things we really should do if we're looking for investments?
Sure. Yeah, so I'm very much into passive index
Yeah.
investing as opposed to active stock trading. It's just, unless you're wanted that to be your full-time job or you're the stock trader and you're working on Wall Street or Bay Street, then okay, if that's going to be your livelihood and that's going to be your sole focus in your career, okay, I wish you luck and maybe you'll do very well. But I would say for the overwhelming majority of us, that's investing, we have other jobs, right? Like we have our full-time job probably.
Yeah.
We've got other obligations. Maybe we have kids already. Maybe, there's other things we got to do. And so we don't have that much time to spend on researching all the different investments on different stocks and that kind of a thing. And so, yeah, so as a starting point, I would say definitely strongly consider just passive index investing. So you're not going to be going for those home runs where, you're trying to find the next Amazon before it becomes, Amazon, right? So you're just let that go and just say, look, I'm just going to invest in the index, just buy the whole, buy a representation of the market as a whole and just, hold long-term, and just do it that way instead of trying to kind of go for these home runs like, oh, I'm going to put all my savings in the crypto, or, a while back it was before crypto, it was, oh, I'm going to put into weed stocks because marijuana is getting legalized in Canada. So let's go, and people are all doing all this speculating because they're trying to get rich quick. And some people, do okay with that, but the vast majority do not, right? And you only hear about like the success stories. You don't hear it. No one's there bragging because they lost $10,000 because they were trying to get in and then everything fell down, right? So just be really careful with that. One resource that I wanted to share with you or with your audience that I think could be helpful is, if you're going to do DIY investing in index funds, which is what I personally do and what I recommend for the overwhelming majority of people, there's different kinds of it. So there's, on the one end, we've got robo advisors, which you're going to pay. It won't be as tax efficient. You'll be paying higher fees, but they hold your hand a bit. They make things very automated. It's very easy to get into. You don't really have to know too much. Then we get into sort of the little bit more advanced, which is it's called asset allocation ETFs, where you're just buying one ETF, and that ETF holds other ETFs that represents the whole markets across the world. And so that's a little bit more advanced, but not by much. And that's another way you can go, and then you're going to pay lower fees and you benefit that way. And then sort of the furthest side, I would say, is buying individual ETFs, which is what I do. And when you do that, it is more complex. You have to do something called rebalancing. You have to figure out which ETFs you want to buy. It's a little bit more work, but you get the highest tax efficiency and you get the lowest possible costs. And so there's sort of the spectrum where the more hands-off you want to be, the more you're going to be paying in fees and you're going to miss out on some tax efficiency. And then when I say like time commitment, I'm not talking about 8 hours a day to manage your portfolio. It's actually very, very simple. It's a very small amount of time, but not everyone wants to kind of go to that advanced level right away. Some people are a bit intimidated. Maybe they want to ease into it. So I would say to answer your question, figure out kind of where you want to start. Do you want to just do with a robo-advisor? Do you want to do an asset allocation ETF, or do you want to do individual ETFs right away? Like I did individual ETFs right away because robo-advisors didn't exist when I first, or at least, they weren't like readily available when I first started. Asset allocation ETFs in Canada didn't exist when I first started. So I didn't really have that much of a choice, but because I invested such a long time ago, but now Canadians have really, really good options. So the resource I'll share with your readers, if you go to buildwealthcanada.ca/investing style, that is a video. So I run the Canadian Financial Summit, as I already mentioned. And one of my talks last year was on exactly this subject. Which type is right for you? What are the pros and cons of each? What can you expect to pay in fees? What's time commitment for each one? And so it was just a good educational resource so you can figure out okay, which one is a good fit for you? And eventually you want to get to that farthest level where you're buying individual ETFs, I would say, because then, you want, when your portfolio gets big, those little tax efficiency, those little cost savings, they really add up. But in the beginning, if you're just getting started, maybe your portfolio is really small, like if you're student or you just haven't been investing before, then yeah, maybe you start off with an asset allocation ETF, keep things simple, just to not get overwhelmed by all, everything that there is to know, and then you kind of move your way. So it's buildwealthcanada.ca/investing style. And it's a free video. Like you don't have to pay for it or anything.
Got it. And what would you say, like, so it's very good strategy to step into the ETF, but what about those like blue chip companies? Those are like giving dividends but are not growing that much. You think like it's also good way to step into those, or like no, it's good to just step into the ETF and take low risk, be more conservative?
Yeah. So I don't do, so yeah, that's a good question. A lot of Canadians sort of there's this allure to dividend investing that, oh, I invest in these big blue chip companies and they just issue dividends. And so that has this perception of being nice and stable and all that. And there's been a lot of really good research done on this about sort of being a ETF index investor just on a broad level, just buying like the entire market or a representation of the entire market versus being a dividend investor. And basically the conclusion, without going into, because that could be an episode all on its own, is just talking about, that. But the conclusion is really, you don't really care so much, or sort of the best practice and what other research has shown is that you shouldn't so much care about the dividends. What you really care is your total return. So your total return is your capital gain, so how much it actually went up in value, plus your dividends, right? So those two things added together equals your total return. So that should be your focus, right? Because you might find some company that, oh, it's giving you a great dividend, fantastic, awesome, but so a lot of the companies that issue high dividends, they're these sort of slower growth companies, right? They're established, right? And so they're not going to be growing as much as some of these other companies that are smaller, right? And so, yeah, you may get a higher dividend, but what would you like? Do you want let's say, do you want a 4% dividend, or like, and that's like almost your entire return? Or do you want a much higher return where, yeah, you get less dividends, but the growth is a lot more, right? And so definitely my approach, and I've looked into this a lot because it's a very important part of the strategy, is to just go for the broad market index investing. And then if you need money, then you can sell off a portion of your investments, right? Like in your retirement, and you can use that. So it's almost like you're creating your own dividends by just selling off a portion, of that. And if it's always growing, right, then, I mean, the market's going to fluctuate, but you're able to take money out of it, and especially if you do it properly, you can do it so that you're not taking it out when the market's at the bottom. And so it's kind of like you get to have your own dividends, right? Without actually digging into your principal if you don't want. So sort of the short answer is, I personally, I don't focus on dividends. I like more total return. I like the more broad market. It's also a lot more diversified. And that way you're also including companies that have higher growth, as opposed to just focusing on smaller companies. Just focusing on dividends.
I'm just